All right, let's talk about something that happens on the journey to building wealth. There's this specific point, this number, where the whole game just feels different. It's not about being rich overnight, not at all. It's about when the mechanics of money truly start to work for you. We're going to call it the $50,000 inflection point.
Does that sound familiar? You know the feeling. You work so hard, you're disciplined, you're putting money away every single month, and you look at your account and it just feels like it's barely budging. It's almost insulting, right? Like all that effort is for nothing?
But here's what you have to understand, and this is so important. That feeling isn't a sign that you've failed. It's not because you picked the wrong investment or your strategy is broken. It's built into the system. It's a structural, totally predictable part of how capital actually grows. So let's really dig into this problem. Why does it feel like you're running in mud at the beginning? It's like there's this invisible barrier you just can't seem to break through. Well, there's a name for this phase. It's called the contribution-heavy stage, and it's exactly what it sounds like. In the beginning, pretty much all the growth you see comes from the money you put in, your savings, your hard work. The investments themselves, they're not really doing the heavy lifting yet.
And look at this chart. This makes it so clear. In a typical early year, your own contributions might be responsible for, say, 95% of your account's growth. And the returns from the market? A tiny little 5%. That's why it feels like your progress is tied one-to-one with how much you can scrape together to save. Your money isn't really working for you yet, you're just piling it up. And let's be honest, that is psychologically brutal. It's so easy to get discouraged and think, what's the point? But you have to remember, this is completely normal. It's just the math of how capital works when you're starting with a smaller base.
So how do you push through it? I love this analogy. Think of it like pushing a giant boulder. At first, it's all you. It's all your effort just to get it to budge. But eventually, it starts to build its own momentum.
Check out this timeline. Now, the numbers here are just an example, but the principle is what matters. Getting your first 20 grand might take, say, 19 months. But the next 20 grand, suddenly it only takes 13 months. And the one after that, just 9. You see what's happening? The amount of money is the same, but the time it takes to get there starts to shrink. So why is that?
It's because your effort, the money you're saving each month, that part stays the same. But your capital, the money that's already in the account, it starts to pitch in. It starts earning its own returns, and those returns get added to your savings. The boulder is starting to roll downhill, picking up speed all on its own.
Okay, so this all builds to a specific point, a threshold, where that shift from effort to momentum becomes really noticeable. Not just on a spreadsheet, but in how you actually feel about your money. And that threshold tends to hover right around $50,000. Now, I have to be clear, this is not a magic number, no alarm goes off, but it represents a point where the math and, just as importantly, your behavior start to fundamentally change.
This slide just lays out the before and after perfectly. Below 50,000, growth feels linear. It's all about your effort. And when the market drops, it feels like a personal attack, like someone just stole your hard-earned cash. But once you're over that line, growth starts to feel buoyant, like it has a life of its own. In a market drop, it still stings, but it feels more systemic, like you're just riding the waves of a much bigger system.
And that's the real secret. It's not that $50,000 is a magic key. It's just the point where the quiet, slow, relentless math of compounding finally gets loud enough for you to hear it. It finally shows up on your account statements in a meaningful way, and that changes your entire relationship with the process.
And that change in your relationship with money, well, that's everything. It's a behavioral shift that totally alters how you think and act with your own financial strategy.
So what does this actually look like? Well, for the first time, you might have a month where your investment gains are bigger than the new money you put in. That's a game changer. Suddenly, market dips don't feel so terrifying. You start to really get that time is now a bigger factor in your growth than your own savings rate. And because of all that, you can finally stop making emotional decisions and start being truly strategic.
This all leads us to one final, huge reframe. And it's kind of a hard truth about what you're really doing in those first tough years. Let's just say it plainly. For your first several years of investing, your goal is not to generate big returns. If that's what you expect, you're going to be disappointed, and you're probably going to quit. Those early years are about one thing, and one thing only: the thankless, grinding, often frustrating work of positioning. You are just hauling your capital into place. You're building a base that's big enough for the laws of compounding to finally grab hold. You are just getting that boulder to the top of the hill. But here's the thing. Once that boulder is rolling, once your capital starts to build its own momentum, the whole game changes again. Your focus shifts away from just piling up more money. The main question isn't how fast can this grow anymore.
The real question becomes, how stable is it?